You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options. Facebook.com/TheOptionsInsider or via questions at TheOptionsInsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and Jill Malandrino.
All right, everybody. That very, very aggressive tune. We like it. It means it's time once again for Options Bootcamp, the program here on the old Options Insider Radio Network, where we break down the sometimes scary and impenetrable world of options and explain how you, the typical retail stock trader, or maybe an ETF, maybe even a mutual fund guy, how you can utilize these scary products in your own portfolios. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting, at least we hope so, Options Insider Radio Network. If you're just listening to Bootcamp, we know there's a lot of you out there. You guys owe it to yourselves to upgrade over to the full network, all 15 or so shows there. I get you the daily news, I get you Option Block twice a week, I get you Vol Views, TWIFO, all the good stuff we do here, the Advisors Option, all the many shows we produce here on the network. I guarantee you, we will keep you busy with options-oriented content. So wherever you're listening to this, could be on the website, could be on iTunes or Stitcher or via our app even, hop on over to the full network feed. You'll get all the shows. I guarantee you, you will not regret it. And of course, however you listen, make sure you hit us up. I know a lot of you guys do. We have quite the backlog of questions. In fact, we're going to get to a lot of them on this episode, so stay tuned. But before we do that, let me welcome on my cohorts, my partners in crime, my fellow Bootcamp drill instructors, starting off with the man you probably know from his myriad appearances over there on the old Option Block, making his 3rd appearance now here on the old Options Bootcamp drill instructor proving ground, Mr. Rock Lobster himself, Andrew Giovinazzi from OptionPit.com. Mr. G, welcome back to Bootcamp, sir. How's it feel getting upgraded like this?
I actually wore my boots just for the show. I'm recording the show in boots, if that helps anybody's visual for this particular show that's listening on.
Of course, you are
downloading.
You are beaming in from Maine, the state of LL Bean, so I think boots are required 365, 24/7 out there. So bear that in mind, listeners, as you hear that. But that said, we appreciate the effort. All you're missing is the hat and the old whistle. And also joining us is our fellow new drill instructor here on the old Options Bootcamp proving ground. She is Jill Malandrino, the global markets reporter over there at NASDAQ. Jill, welcome back to the show, and we're beaming you in via the magic technology known as telephone. We'll be sure to upgrade you on future shows, but you have been living up to your title recently, traveling all around the globe, but I'm glad we can get you in one place to join us on Options Bootcamp today.
All right. Well, thank you very much for having me. I love the intro. I need to have that when I walk into the studio. That was pretty aggressive there.
Yeah, kind of get you going. I like that. So maybe we'll send it over to you. You can play it. You can play it when you walk into any office. I'm sure people on NASDAQ will appreciate that. All right, with the team assembled, like I've been promising you for a while, we're going to get to your questions. So without further ado, it's time for a super mega mail call palooza.
Mail call Time to look at questions submitted by our listeners.
All right, everybody, welcome to the mail call. Like the man said, this is the portion of the show where you guys take the reins and hit us up with questions, comments, insights, pearls of wisdom, suggestions for future shows, all that fun stuff. You guys, judging by the response, already know how to find us. But if you're curious, the easiest place to probably, a lot of you like to hit us up on social media. So at Options on Twitter or over there on StockTwits, Options Insider on Facebook. We just added, for those of you who asked, just in the past week, we just added an Instagram account. I believe we are Options Insider over there as well. I'll have to make sure I get the right handle for you there. And of course, the old-fashioned way works as well. Questions at theoptionsinsider.com, or use our feedback form on the old website. A lot of you guys like to use that as well. All right, without further ado, let's start cranking through these babies. See how many we can answer in one episode. We'll kick things off nice and easy with a nice comment from Andrew McNichol. He says, a big fan of your podcast. Well, thank you, Andrew. I could always tell you were a man of great taste just by how you write it. He goes on to write, I appreciate how you start at square one and then walk listeners through every element of options and options trading. Thanks. Well, thank you. Thank you back right at you, Andrew, for all the love. Nice to be appreciated out there. All right, moving on to this question here from Tim D. Mr. Rockloff just kind of touches on what we were talking about, what I joked about on our last episode of Bootcamp, which is the lack of love that Ro gets, a.k.a. the redheaded stepchild of the Greeks. Tim D. wants to know, how high do rates need to be before I worry about Ro? I think we've had a couple of questions about this on some of our other programs recently, which maybe tends to show the rates environment we're in. Rates are top of mind. In fact, this is a timely question. Just recently, the Fed announcing they're trying to get a little more hawkish towards the end of the year in December, so maybe rates going to be back on the horizon again sometime soon. Excuse me, but you know, it always cracks me up when we get a question like this, because people who write into this, let's say 70% of them are probably out there slinging weekly options. So they will never probably have to worry about Ro unless they're doing something really weird, trading really deep in the money, something strange out there. Because think about it, listeners, Ro is effectively interest rate. So what is effective interest rate? It's the time, it's the cost of carry. It's just that kind of extrinsic part of your options value. And a lot of these weeklies and even monthlies that you typically probably trade don't really have a lot of time, a lot of carry really involved in them. So you don't really have to worry about that. So when you start getting a lot farther out on the options time horizon, you're talking leaps, 1 year plus 2 years kind of contracts, things that are deep and long and meaty and in the money, that's when you have a lot of carry, and that's when you start looking at Ro and being much more of an impact. So I would even go as far as say for probably the lion's share of you out there who are probably trading 1 month or shorter duration when it comes to options, you're probably not really going to have a lot of scenarios where you're looking at Ro. Maybe, I guess, if you're getting into your 401ks, getting into some longer term stuff, doing some stock replacement, maybe that's an issue. I don't know, Mr. Rockloff, I guarantee you've probably done a webinar or two about Ro in your day. What do you tell the folks like Tim who come to you and say, well, when should I start worrying about this Ro thing?
Actually, the only webinar we tried to do for Ro, we canceled it because we only had 2 signups and we returned the people's.
I was just going to say, I bet you that was your most attended webinar ever.
It was the least attended webinar in history. Right now, I would say most Ro on most positions within 3 or 4 months probably don't even make a difference to the bid offer. Meaning, the change in interest rates, it's not. The change in Ro won't even affect the bid offer on an option series. So the only time you really care about Ro really is with leaps. And the reality is the Fed has kind of telegraphed some rate hikes. So you know what the liquidity providers do? They put higher rates in the future in their model. So you're already paying higher interest rates for options out there anyway. So, the only time I would say the cost of carry like this matters is if you're trading massive index boxes, which I'm going to guess most of the people listening to this show are not doing.
I didn't tell you this is the Index Box crowd who put this out to you. The Index Box Club of Poughkeepsie really loves this show, so they're gonna be brokenhearted. Everyone else will be happy. I don't know, Jill. You're out there talking to a lot of different audiences when it comes to options, retail, advisors, institutional, all over the globe, as we said earlier. Does Ro even come up on their radar? Is anyone asking you about this, or is this still kind of few and far between for you as well?
No, I honestly have nothing to add here. I don't think I've ever had that question come up. When we talk about, we mentioned this on the prior podcast, when we look at other Greeks that are more impactful, as we mentioned yesterday, delta, theta for some of the newer retail investors. I know Andrew had mentioned looking at vega for some more of the complex trades. But I don't think there's anywhere that I've been, whether in this space or abroad, where Rho has actually come up. So I don't really have anything groundbreaking to add to that.
I think that says it all right there. I think if people were hitting you up left, right, and center to talk about Rho, it would be a different conversation. But yeah, I think the truth is 90% of you, I'm going to go out on a limb and guess. I don't have the actual data from OCC and how much trading is in the leaps, what volume, but I'm going to go on a limb. Let's make it more conservative. Let's say 80+% of you out there will never really need to materially worry about Rho. And if a handful out there where you are slinging boxes and deep in the money leaps, well, then maybe we have another show for you. Maybe we can talk about that. But most of you, not really something that's going to come up on your radar. Since Jill was talking about the Greek she likes and things, this perfect segue to our next question here comes from Kraken 19. I like that handle, Kraken 1975. I think it's appropriate that someone with that handle should be asking about the Greeks. Clearly a man who appreciates some good Greek mythology, or at the very least some good Greek mythology movies. He asks, which of the Greeks do you utilize the most? And why? Interesting. We touched on this yesterday. There's always, as long as I've been involved with options, there's kind of been this delineation a lot of people have where the retail fixates on delta and then the pros fixate on vega. As I mentioned yesterday, I think for a lot of the active higher end retail, you should also add theta into that equation because a lot of them are premium harvesters out there. They like that decay. So theta becomes a big component, whether they realize it or not. Of course, theta and gamma, two sides of the same coin, so they become related. But if I had to go out and say what I look at a lot, it'd probably be vega for most of it, and then, a lot of theta decay as well. I don't do a lot of delta heavy trades where I'm looking to really trade a lot of deltas, so that doesn't factor into a lot of my trading, but it's certainly something to be cognizant of. But the way I trade, typically, I'm not going out there and loading up on in the money calls as some sort of stock surrogate or things like that. So not really my cup of tea. So I have to say vega and then probably theta/gamma. It's hard to really separate those two because they are very much related. So I go that way. If that's a cheat. I don't know. But Jill, you were just talking about which Greeks are on your radar. What do you have to say here for Tim? For Kraken 1975, the well-named Kraken 75. Which Greeks do you like? Which ones are you hearing about the most over there in your global tour over there at NASDAQ?
Yeah, well, we hear about delta a lot, and as we mentioned yesterday, that's simply just a measure of an options position sensitivity to changes in the underlying asset, whether it's a stock or an ETF. So basically, if the stock goes up by $1, the option position either moves higher or lower by the amount of delta. So the percent example that we used yesterday was 35. Since the delta is 35, the option position makes or loses 35% as much as the underlying asset. So that's really what that is. It's the sensitivity to the changes of the underlying. And as you mentioned before with data, we hear this a lot now, particularly with premium selling being such a hot topic. That's really where you talk about having time on your side. And, that's really, as data passes, that's really going to help determine whether or not you're making money or losing on these premium selling type of positions, which, I'm a bigger fan, as Andrew had mentioned, of hedging just about every position that I put on, and so that you don't quite have that data risk that's out there. But, at a very basic level, the value of your options going to change as time passes. So those really are the two that we hear about the most, particularly with this premium selling environment that we're in right now.
Mr. Rocklofts, the same question for you. We touched on this a little bit yesterday, but what do you like to use when you're out there slinging them options, sir?
Considering this is like half of our pro course talks about exactly this subject. So
you're going to say
exactly,
Rho. Rho is what you focus on the most.
Like I said, gamma from a risk control point of view is yesterday. That is important. Guys in our chat room, what's the cheapest delta I could find to make me the most money? And everybody likes positive theta. Although on a day like today, it's not a positive theta day because everything's just kind of going straight up. So unless you just sold put spreads that generate positive theta, if you have any iron condors, you're probably, if you're short some call spreads up there, you're chasing them a little bit. So I'm always as conditionally, I've been conditionally programmed with Greeks. So I would say this is basic boot camp stuff. But you want to have the right Greek for what you think is going to happen. So if you want delta, if you want to be long delta, you want to make sure you have the right thing. You have to understand how your delta is going to work, like Jill says. If you're short gamma, you have to understand what it takes to make short gamma work. If everybody, positive theta is easy because you just get it. If you're long options and then you have negative theta, you have to make sure that whatever move is going to happen is going to pay for the theta. So the Greeks have a reason because they're telling you what you need to do or what the position needs to do. So they're kind of like having the dashboard on your car. There's a speedometer, there's RPM, there's also, okay, my car's out of gas, all the different things to help you kind of navigate the way your option position is going to work. And again, just like anything else, kind of hard to drive your car without your dashboard. You can do it. That doesn't mean you should. So I would think of it more or less like that.
Good analogy. You're full of good analogies. Interesting to hear, too, that people are coming, your people I would assume coming to your chat room are still somewhat sophisticated in options, and they're still coming to you for the cheapest delta. It's still what they all primarily want, the cheap deltas? Well,
cheap delta for sure, just because basically, so the idea, too, in our chat room is, we have like the different levels. So the upper levels of education are more positioning. The chat room is like, okay, something's moving. What's the cheapest delta I can find? Or will I make any money buying this call if the stock moves? Asking questions like that. So, but sometimes with a cheap delta, the whole idea too with options is you want the leverage. So you want, low dollars to turn into big dollars. So what are the contracts that get you the most bang for your buck? So that definitely is a topic in the chat room. And it's one that Mark likes to, he likes that topic. That he's very happy with that topic.
You guys over at Option Pit reinforcing the stereotypes of retail traders everywhere. All they care about is delta. I like it though. Interesting stuff. You got a good question. You got good handles this episode, this show as well. Meatz, Meatz with a Z, writing in. Would you describe successful options trading as primarily singles and doubles, or more swing for the fences home runs? Let's be honest, Mr. or perhaps Mrs. Meatz. If we told you right now, truthfully, it was all about swinging for the fences home runs, would you view us as credible? Would you say we were credible educators or options evangelists, or call us what you will out there if we said it's all about home runs? No, of course. It's about singles and double. Any successful trading regime is going to be about that. It's going to be out. Look at the primary use cases for options. So many people are out there trying to generate a little bit of extra income on top of their existing long equity portfolio. Covered calls, short puts. These are huge use cases for options. They're just trying to get a little bit extra dividend stream on top of what they're already doing. Sometimes you lever that up with spreads and things like that. You start getting into the next tiers of trades. But very often, so many of the use cases for options are just kind of chipping away a little bit at trying to get a little bit extra. You're offset if you got some long theta. You got a decay. Got some negative theta, long premium. You got to try to chip away at that with some others. You can start mixing in a little bit there and trying to offset that. A lot of use cases for the singles and the double. Not a lot of bunts. Maybe a few bunts. Maybe that'd be like trading in somewhere in the weekly / dailies. But that said, a lot of singles and doubles. That seems to be the way most responsible people. If you're loading up all the time on cheap 5 delta options and swinging for the fences all the time, guess what? That's not really a good long-term trading strategy. Miss Jill, what do you have to say here for our friend? Another creative handle, Mr. Meatz with a Z.
Well, this is a really interesting topic because what I'm starting to see a lot more now is people are using options as a day trading vehicle. So I think personally, and this is whether you're a stock trader, options trader, that it's a very personal decision, although I would say longer-term people who have been in this game and have not blown up their portfolios, they are going for singles and doubles for sure. It's just a responsible way to trade, and your smart traders will walk into a position and they'll, the question they'll ask themselves, let's talk about the risk scenario here. What can I lose? How does it impact the rest of my portfolio before they start thinking about, okay, well, I can make 100%, 200% on this. I find myself, for example, I like to have a certain target to the upside, a certain target to the downside, and I don't try to push that just to be consistent on all of my trading. But this is something that's really interesting as you start to see options used as a day trading vehicle, particularly as equity trading is, I wouldn't say it's on a decline, but there is a lot of frustration out there just due to market structure and some of the more complex conversation around that. But I'm really surprised to see the uptick of how you're starting it to see it more day traded, and curious to see how that will make a wider impact.
That's a good point, I think, actually, with the day trading, because we have similar themes to this question. Usually it's asked in that kind of time frame or that kind of frame of reference, which is more of a duration question, which is, hey, are options better for options suitable for day traders, or are they more longer term type traders? So Mr. Rock Lobster, you can answer it however you like, maybe both. Mr. Meatz wants to know, is it better for singles and doubles? I think we know the answer to that question. But also, how do you view these products? Do you like, obviously you have people in your chat room looking for cheap deltas, so they're probably looking for, more shorter term type trades. So do you use them like that? Do you like people setting up for longer term? What is your preferred go-to use case?
For setting up long deltas, I'm sorry. This is another one of those. Sometimes I have a hard time with these dang questions. So, because
you have a hard time with the basic questions. All right. So, Mr. Meatz, let's keeping it to strictly adhering to the question. Mr. Meatz wants to know: would you describe successful options trading as primarily singles and doubles, or more swing for the fences home runs? And then Jill added an interesting corollary to that, where what do you think about using options as a day trading tool versus maybe the more traditional use case of, writing a call once a month, a little bit more long-term stuff?
It's amazing that I even get to that original question after all of that stuff that comes through. I had to get back to the question. Anyway, mostly yes, option trading I think is singles and doubles, because usually home runs are, luck. Home runs basically mean that the option itself has performed way and above whatever the implied volatility that you priced the option with in the first place. So something pretty enormous has to happen. Doesn't mean it can't happen. It just, as all, because we laugh on the option block when somebody does those crazy trades on the odd block. Like, this statistically has no shot in heck to win. And then lo and behold, something totally magical happens. So if you have to learn how to just sort of make money with options. Now, the idea of using the options as a day trading vehicle, that does give you the potential for kind of a home run because of, the leverage in options. You get a $1, $2, $3 move in Apple in one day, and you make a lot of money buying calls when the volatility is only 17%. So that is, again, that's a kind of a skill, knowing where, like, our roomies come and ask about, where's the option that really gives me some really good leverage. That's something that you can learn about. And Jill, as far as when you guys are talking about, people that just want to write calls every month, totally acceptable way to do things. And it's just what people are comfortable with. One thing I've learned teaching retail clients to kind of trade more professionally, not that really professional traders might be any better, because I have a lot of smart retail clients. It's just how they view, risk. But also professionals have if they're looking at the market all day, they're looking at the market all day. If somebody has a job, maybe the most they can do is just write some calls every month, and that's it, because that's what they have time for. That's what they can handle. So a big part of, what you can trade, whether you're a swing for the fences person, just decide, well, I'm going to take 10 grand a year and I'm just going to sling option trades and see what I get by the end of the year. If that's what makes you happy, go ahead, as long as it's money that you can afford to lose. And like I would say, is less than 5% of your net worth or less, if you're going to do that. That is, again, people get their excitement in different ways from trading options. But if you want to do it sustainably, our most successful guys are definitely, single, double, every once in a while a triple. And, a home run happens, but it's not something you can totally count on. I'll give you a good example, though. So last week in our chat room looking at NVIDIA, We're looking at implied volatility. So the price of options, I'm like, way too cheap. So Mark and I are looking at it, and he's like, okay, so buy a strangle. So we bought an unbalanced strangle. That's buy a call, buy a put on a ratio of, 9. I think we bought 7 kind of in the money-ish calls to 6 puts, because the risk reward profile, based on how NVIDIA was moving every day, we basically had a free shot at 1 day movement. So we're like, with a free shot at 1 day, what the heck? We didn't know NVIDIA was going to go up $20 in 2 days, but it did. And the trade ended up being a home run, and Mark scaled out of the calls, sold his calls out. And then as soon as he was done with his calls, he just left the puts for a day or two to see what happened. And NVIDIA dropped $20. And then he sold the puts out, and it was a total home run. Now, did we think it was going to go up $20? No. The original idea was we are looking for pricing that gives us very advantageous odds to start. And if nothing happened over that day, that would have been fine. But wow, stock was up $6 that day. So like, okay, we'll hold on to this a little longer. Stock up a bunch more. So you never know what's going to happen after you put the trade on. After that, all you have really is risk control and management. But like I said, home runs are fine, but mostly you will just be lucky if they happen.
So what you're telling me is next time you guys are in town, the stakes are on you.
The stakes are on Mark, for sure. I think you hit him up. Aren't you going to hit him up tomorrow?
I'll be seeing him tomorrow. I'll be seeing him tomorrow, so I'll have to make sure maybe I'll have a surf and turf to go.
He might tell you about that trade. He's still kind of floating around on it.
I'm sure he will. If he has a good home run, let alone 2, how often does it work that way where you get both sides of it like that? I'm sure I will hear about it from him tomorrow when I see him. All right, next up, LCB. He or she wants to know, they have a question about low vol selling. They said, this is a challenging time to sell options due to low volatility. Well, that is true. They go on to write, so does it stand that the opposite is true? Is it a good time to buy options, particularly protective puts? So this gets into a lot of interesting areas. We touched on, obviously, a little bit of vol on our overall Greeks review or Greeks primer yesterday, or on the last Options Bootcamp episode. If you want a lot more detail into it, I encourage you check out the archives of this show. Look up the volatility episodes, and especially some about skew, because that's where you're going to start getting into some of the interesting things. Theoretically, yes, on the surface, with implied vol much lower now, it is cheaper to buy options than it is when a high volatility environment. That is true. But also, particularly when you're talking about protective puts, I'm assuming you're probably talking about indexes. Maybe you're talking about individual name equities, but it tends to apply to both. You have a scenario where that volatility skew is really going to be the question you have to answer for yourself then, because it is possible for vol to be low, and yet let's say where we are in the S&P right now, where things are starting to get a little bit lofty from a valuation perspective. So guess what? Vol is low, but people are still bidding up those puts, looking to get protection, perhaps more so than ever because they're worried about these valuation levels. So even though net vol is low, that's just at the money vol you're typically looking at. You have to look at some of your out of the money strikes on those puts where you're probably going to be buying your protective puts, and there probably is a different story. It's kind of hard. A lot of the platforms don't really allow you to analyze this very well. One I can recommend, actually, we do work with them on our TWIFO program, and they have a great free service you guys can use. It's called Quick Strike. It's no C, so QUIKSTRIKE. I think you just search for Quick Strike Essentials is what you want to find. That's a free platform. Everything's free to use. You just log in, and you can have they have a cool tool that we use a lot called Quick Skew, and it answers this exact question. In particular, it breaks down the calls and the put wing independently, which is unique. I've never seen that before, which is great for exactly what you're looking for. You want to look at not just the overall skew, but what the put wing is doing. And that tool will allow you to do that. You don't say specifically which names you're looking at, so we can't get more specific than that, but that's a great tool for doing this analysis yourself. And you could say, well, actually, historically, compared to where skew usually is, these puts are actually kind of rich. Maybe I want to look at something else. Maybe I want to do some sort of spreads to offset this, or take some other strategies to help offset that cost, or maybe not buy them at all based on your analysis. Let's go back around the horn the other way. Let's go back to Andrew. Mr. Rock Lobster, obviously, there's a lot we can unpack in this question when you get to skew and things like that. But in general, 10,000 foot, is it a good time to be buying some protective puts, sir?
Well, overall, I would say vol is pretty low. I mean, VIX is 9. So I think the cheapest thing you could buy is a put butterfly, or a put spread. It will never be cheaper than it is right now to buy those, because both of those trades basically sell skew. So you can buy, relatively close to the money put spreads for pennies. I mean, in the SPY, almost nothing. Butterflies, you could buy 5-6 handle butterflies, and what I mean 5-6 handles points wide. Put butterflies for 30 cents, 40 cents in the SPY. Very, very, very inexpensive downside hedging. So, and as a trade, I mean, I like stuff like that. Says because your hedge is so inexpensive, you can even buy a couple of calls and then just sort of let the market do its thing. That's kind of a standard old school bull market trade. So when the skew is very expensive, that gives you some opportunity because it makes your overall net hedge really cheap. And then you figure, okay, well, now I can go do something else. So that might be a little, I don't know if that's sophisticated for the show or not, but that is a way. Now, skew right now is not abnormally high. It is kind of in the middle of the range. Considering how cheap VIX cash is, it's surprising how low it is, to be honest. I'm a little surprised by it.
You're easily surprised, man. Scaring people with butterfly talk here, sir. On our basic options. Now, actually, we're answering questions of all levels. So it's not just basic. But if you are scared by that talk of butterflies, check out our episode, listeners. Spreads with Wings and many other episodes we do where we detail things like flies. Basically, what he's talking about: buy one, usually near at the money put, sell some ratio, typically 2, a little bit farther out, and then to protect against the worst happening, you buy another one a little bit farther out than there. You can do it on different ratios. You can do different strikes. You can skip strikes. A lot of ways, a lot of flavors that flies come in. That's pretty much the basic gist of it. But again, as you mentioned earlier, you have to usually have some sort of short leg to offset the skew that you're encountering out here these days. Jill, I'd imagine as you're traveling hither and yon around the globe, you're hearing a lot of talk about low vol. What are people saying to you, and what do you have to say to our friend here, Mr. or Mrs. LCB? Is it a good time to be buying some protective puts?
It's so interesting. I was actually going to take this question from an anecdotal, fundamental perspective, and it's not just retail investors that have their hands up in the air with this, but it's also your sophisticated asset managers who are kind of still scratching their heads. I was in London last week at NASDAQ's buy-side symposium, and actually one of the panels was dedicated to the low vol environment that we're in, and it's really anyone's guess because it's the year isn't playing out the way that people had expected it to. So I think there is a lot to be said about that when you also have the professionals questioning when vol will return to the market. I will say, though, and this is from a broader options industry perspective, that I think it's quite impressive, even in this low vol environment, we're continuing to see volume growth in terms of trading. And I think that's pretty impressive. So if you can only imagine when volatility does return to the market, and it will at some point, I think that says a lot about the options industry itself. In fact, yesterday I hosted for the Closing Bell the OIC, the Options Industry Council, which is one of my favorite education broader sources that are out there, and the OCC rang the Closing Bell. And for the OIC, it was 25 years of them being around supporting investor education. So I just want to give them a shout out. I know Mary Savoy is a good friend to the show as well. But I really think that says something to the industry itself with the volume trends that we're seeing in such a depressed fall environment.
Yep, we just had Mary on the network, I believe, last week talking about that milestone 25 years over there at OIC. Hard to believe. Certainly they've been around as long as I've been in the business, and it's hard to imagine an industry without them out there fighting the good fight, spreading the good word of options without any sort of bias, any sort of agenda. They just want to teach you about options. It's a great thing. All right, moving on here. Speaking of low vol and still doing numbers, though, you're right. I mean, Andrew's mentioned VIX is anemic. It's in 9 single digits, and yet we just saw the biggest single volume day in VIX history. So it is a little bit counterintuitive that vol is low, and it's traditionally a challenging time for a lot of premium harvesting strategies, and yet the numbers are actually up this year. So it's kind of head-scratching. Interesting to see. Retail, I think, accounting for a lot of that. Hopefully this show helping to push people back out there and not be afraid to trade up some options. All right, next up, we got a question from the very straightforward handle of Mary. Mary wants to know, I like to see the ladies writing into, what's the shortest expiry available for plain vanilla options? So plain vanilla, I'm assuming she means standard listed equity and index option. That's the frame of reference I'm going to use for this question. Not some weird exotic OTC, but then you can have whatever the heck you want. But yeah, plain vanilla options. You're pretty much, you see a lot of action, as you mentioned now these days, in the weeklies. The weeklies are pretty much the shortest duration you're going to get for most of these standard listed products. That said, we're starting to see multiple weeklies be listed. So we're seeing Monday weeklies and Wednesday weeklies, and then your traditional expiring on Friday weeklies. So we're not that far away from a scenario, maybe, who knows, maybe a year or so, maybe a little more, maybe a little less, where we have effectively weeklies expiring every day. And once you have that, you effectively have dailies in the marketplace. So I would say right now it's weeklies, but there are days if you come in on Wednesday and you buy an option expiring that Wednesday, that's a daily. So, I mean, it depends on how you're looking at it. But yeah, technically, the shortest is weeklies. That said, we do have Jill here, representative from NASDAQ, who owns a good swath of the options industry right now. So, Jill, if you wanted to come on here today and maybe break a little news for us that NASDAQ is about to launch dailies, hint, hint, if you wanted to, have at it. The floor is yours.
Oh, my gosh. I mean, could you imagine? And this wouldn't surprise me if one day we saw options trading on an intraday expiration. I can't wrap my head around that, but who knows? Who would have thought, even let's say 25 years ago, we were talking about OIC, that we would have the amount of contracts that are available today. And I really don't have much more to say in terms of the daily, but I will share something that's interesting institutionally it was at the Market Structure Conference in D.C., what was it, 2 weeks ago? I sometimes never remember what time zone I'm in. And we were talking for the options panel, out of all the panels that were there representing market structure, clearly there are a number of things going on with MiFID implementation and costs and legacy systems. And there's really a lot going on in terms of regulation for the buy, sell side, asset managers, regulators going into 2018. But I was really pleasantly surprised to hear the options panel was incredibly bold up on the industry itself. And that goes back to what I was saying in terms of volume. But from an institutional perspective, one of the things that we hear about a lot is, are there too many strikes out there? Is there too much product out there? Is it too fragmented? And one of the banks that were represented on the panel, they're big liquidity providers, and they, for the most part, provide liquidity for their buy-side counterparts, were saying that they actually like having the amount of fragmentations that's out there, the amount of strikes available, the amount of different expirations, because it allows them to create these complex strategies. So it wouldn't surprise me if we start to see some more demand in terms of availability of product. And I thought that was something, it just struck me that it has been received.
Well, Jill, I'm glad you're making all these conferences all over the globe, because it saves me having to go to all of these. People are always bugging me to go to D.C. and London. I hardly have time, so I'm glad that you can go and represent what you see there on this show. I guess that's a no from NASDAQ right now on the dailies, but we'll keep at you on this. I'm sure people will be writing in again. Maybe we'll have an update. And if you do, or if you are going to announce that, Jill, we'll have to make sure that you definitely, we have to break it here on the old Bootcamp show first. But we get this question a lot, so I'm sure we'll have some variation, some flavor on it coming up again. Now, here's another. This is the fun one, I think, for you, Mr. Rocklops, because you were talking before. You were bragging, some might say, humble bragging about how you guys at Option Pit, you went back and you Frankenstein-esque created a market maker, which I don't think has been done in at least 10 years. There's been such a flight of liquidity providers. But you guys actually took it upon yourselves to create a new market maker and send him back into the business, as mad and demented as that may seem in 2017. So we have a question here along those lines from EJH4. I think this guy's written in before, I think, because he's taken me to task for mispronouncing his handle, because I was just saying, I think he wrote in to explain some elaborate explanation for what that acronym, I think it's Iowa State or Illinois State University, something like that. So Mr. EJH for some university, maybe I'm going to go to Iowa State University. There you go, so you won't be mad. He wants to know, what qualifications do I need to work in the industry as a professional, i.e. as a trader? Is that a career path I'd even want to consider? Well, Mr. Rocklopsy, you guys just minted a market maker. He doesn't say He says as a trader, so I mean that used to mean market maker. That can mean a lot of things now. Typically, it would mean more of a prop trader in 2017 than it used to. But that said, what do you have to say here for Mr. Acronym Soup? What do you have to do, and what should he even want to do this crazy thing called becoming a trader?
Mr. Acronym Soup. Yeah, our market maker guy was a, I would say, he was unique in that he had a pretty good skill set for it, and now you need the capital. So if you don't have that, you might as well forget being a market maker. What you can do is try applying at market making firms but at this point it's more like a video game. It's not the same, you're basically moving skews around, and it is a much different game than it was before. So the only thing I could say is, try a job as a clerk at a hedge fund or a trading desk, or, good luck trying to get a job at Citadel or anything like that. But right now, trading is very, it is electronically more intense. You have to just be better with computers in general. Probably your best shot is to be, get a financial engineering undergraduate degree that at least gets you, somewhat there, or just try. You can't clerk on a floor anymore. There used to be thousands of jobs available to kind of get in. Very hard now to do anything like that. There's almost nothing around for it. So you have to find firms that are still trading electronically and try to get your own, find a place at the table. That's it. It's a little difficult, but firms like, there's still Susquehanna and Citadel, and Group 1 is still around, and there's still firms out there that do make markets, and that would get you an education, because it's kind of hard to sort of start on your own and just sort of, jump into the electronic marketplace. I think that's part of why some of like the education businesses, like one that we have, people are interested in that, because it's what we try to do is kind of create a trading shop where there's exchange of ideas, and there's some risk management, and there's some knowledge. So when you see weird market conditions, somebody can answer a question like, what the hell is going on here? Or what the heck's going on here? So, I think that is helpful, but ultimately you're probably going to have to find, I would say just go to the top 20 or 30 most active funds, hedge funds that trade options, and, start there at this point. It's just a vastly, vastly different game than it used to be.
Yeah, the old days of slapping on a fancy jacket, multicolored perhaps, and heading on down to find your fame and fortune are few and far between. That said, we do have Jill on with us, like I said, from NASDAQ, and it just so happens, it wasn't that long ago, Jill, I don't think. Was it back earlier this year or late last year, where we had Kevin, and I think you on as well, talking about the brand new PhilX trading floor that NASDAQ just relaunched back not that long ago, less than a year ago now. So there are opportunities for that kind of traditional, even become a local, which is crazy to say in 2017. Maybe give us an update really quickly on how that initiative is going. Is that new Philly floor, is it thriving? And then also along those lines, what do you have to say here for EJH for ISU wants to know, should he be looking into this career path in 2017?
Well, we relaunched the floor in April, and we're there each options expiration to report live, bringing in a number of options derivatives and also FA and RIA experts to the floor. And I can tell you that the buzz continues to increase, which is refreshing to see in an open outcry platform. There's not as many locals per se. A lot of it are just traditional brokers and market-making firms that are down on the floor there. Wolverine is one of them, Susquehanna, as Andrew had mentioned. So you still have the bigger guys that are out there. In terms of getting into the business, I would have to agree with Andrew. It's certainly different than, when I started in the late 90s. I think I'm a little bit younger than Andrew. But right now, it's
everyone is younger than Andrew.
Everybody's younger than you. But
everybody.
Andrew's right. Trading these days, it would behoove you, if you will, to probably be a developer or on the side of technology versus straight finance. Of course, it's great to have the finance background, but you're certainly you absolutely have to have some sort of a technical background to even be considered for a spot on the desk, particularly with the financial industry starting to move more towards AI and machine intelligence. The value add of a newcomer to any firm is going to be someone that has had exposure, proven internships, and proven experience on the tech side that is looking to either build out systems, incorporating all of that kind of stuff. So you're seeing, and even different business schools that I've visited with for different options industry things, we're getting the most interest from people in those types of programs in the business school, those of them that are looking for developing, coding, AI, machine intelligence. So it certainly is very different, and of course a math background than perhaps when we first started. But you know what, I think there's also the opportunity on the market structure and regulatory end. So if you're interested in finance and you also are interested in law or something a little bit higher level than being on the floor, there's certainly an opportunity there. I mean, the compliance departments are probably bigger than the trading departments at this point. So there, as the market evolves, so do we. And I think there's more opportunity in that sense because there's different verticals you can explore besides just the desk.
That's a good point. He doesn't mention, he says it as an industry professional. He doesn't mention, he says as a trader, but you're right. You very rarely see compliance people getting laid off. Some may argue that that's perhaps a sad sign for the industry, that there's more compliance people being hired than the actual traders, but that's a conversation for another day. So there you go. If it's a challenge to become a trader these days, maybe market reg or compliance or something along those lines. Certainly boom areas for those aspects. Hard to believe we're almost coming up against it here. An hour flies by when we're having so much fun. Let's see if we can wrap it up on something, one of the crazier questions. Let's see this one. How about this one here from Privateer? I like that handle, Privateer. He says, "Permission to speak freely, sirs." Granted, Mr. Privateer. All right, he goes on. "Hi guys, love the show and the entertaining military-themed education. I've recently been learning about an exciting strategy called writing call options with CFDs. Those are contracts for difference, if you're not familiar with the lingo there, listeners." He goes on to write, "The claim by this teacher is that CFDs can leverage their return on premium selling by 10 times and reduce your break-even significantly. I'm very invested in how this could apply in selling both legs." So 2 legs, i.e. covered strangles or straddles. Can you discuss the downsides, upsides, and hedging strategies used in this scenario and how to mitigate risk, especially on the put leg? Sirs, yes, sir. Oh, wow, a lot to unpack here with this one. We don't get a lot of questions. That's why I like this show. We get weird ones sometimes about contracts for difference. If you're not familiar with these listeners, they're not the most liquid things. You probably haven't seen them unless you have a pretty sized account with your broker. And then effectively, you kind of call up your broker and say, "Hey, I want you to set me up." I guess you can call it in some ways a bit of a poor man's option, a bit of a warrant to it, where essentially they're trading with you the difference of the value and whatever underlying. Usually it's a stock, but it could be anything. So what he's arguing here is by setting these up, they're done on a different margin than traditional stock, which is usually 15%. So your outlay for these contracts is already cheaper. So you have a bit of almost a levered instrument to start there. In some ways, it's kind of reminiscent of the old days. People used to trade options on levered ETFs before the margin started changing on those, where you had kind of levered instrument on top of a levered instrument, and you get a lot of bang for your buck as a result. Sometimes also danger. But he wants to know, so he wants to trade one of these. Let's say he probably wants to buy these, let's say an XYZ stock. He doesn't say which one he's looking at. Then he wants to turn around and sell what he terms covered strangles or straddles. Worth pointing out, of course, that it's not really covered because the put leg is just added risk. And he acknowledges that. He says how to mitigate risk, especially on the put leg. He knows if this thing drops, he's going to be wearing it pretty quickly. So probably the first leg, if you really are obsessed with doing this, is probably to change that put leg into a put spread. That's going to mitigate, that's going to cut off your downside risk on this kind of thing as well. But yeah, I'm kind of going back to the underline. This is CFDs. It sounds good on the surface, but these are things, and you have a lot of issues that we saw come back to haunt you in, the big 2007, 2008, 2009 timeframe. There's obviously counterparty risk with these because you're not doing usually a cleared instrument. You're trading effectively with your broker now. So the broker's got to be around and have the other side pay off. That's a big risk. We saw that play out not that long ago. So that's something to keep in mind. It's not just free you're getting this leverage for free. There's risk attached to that. And on top of that, they're not that liquid. So I'm guessing the market is going to make for you for these things is probably not going to be that tight. So you may be better off at the end of the day looking at how liquid the stock is. The margin is not as favorable, but it might be tighter and there's no counterparty risk. You may still be better off at the end of the day doing the regular listed route. I know it's not as exciting as sexy as doing it on CFDs. But that said, I'll have to spend some time researching how active. I'm sure if you pick a higher name, an active name like an Apple, they may be more willing to make you a little bit of a tighter market. It also depends on your relationship with your broker, how big your account is, et cetera, and so on and so forth. If you're calling up for a one-lot CFD, I'm guessing they're probably not going to answer the phone for you. But interesting stuff nonetheless. Kind of a left field question, kind of fun. I don't know. I'll toss it open to the field. Whoever wants to dive in on this, Jill or Mr. Rock Lobster. Any thoughts on not just using regular stock, but ramping it up a notch with using contracts for difference and then writing calls on that? I don't know. Jill or Andrew, any thoughts?
I would love to have a thought, but generally, I wouldn't trade anything I don't understand first. So I have to go figure out what a contract for difference is.
I was going to defer to you for that too. Yeah, I've only traded listed.
All right, well, there you go, Mr. Privateer. No joy here. I guess we can't close on that one then. Let's figure up one more. But yeah, they're not that liquid. I don't know who this instructor is who's teaching you this, but definitely I would be concerned about those aspects of it. And also the fact that your put leg is not covered. So maybe turn that into a put spread, and maybe you'll be, if you want to write in with more details on exactly what you're getting, how the spreads are and things, we'd be happy to look at it. But it's a good question just because we never get it, which is kind of interesting. Okay, we'll wrap it up on an easy one. I'll let you guys. I'll let Jill choose because she's the new addition to the show here. Jill, should we wrap it up on a question about open interest or about ADV? What do you want to talk about?
I'm going to take open interest because it talks about the OCC, and like I said, we had them there yesterday, and they're so important to the business that without them, the options industry wouldn't function. So we'll take an easy one for the crowd, and also give a shout out for the OCC for the work that they do for us. So
Jill, full of the OCC love today. They're going to love it over there, over at OCC. All right, our last question here coming in, as chosen by Jill. It comes from Axel D, as opposed to Axel F, I guess that was taken. He says, why does open interest only update once a day? This is kind of a common question we get probably at least once a quarter or so, Jill, if not more frequently than that. People are used to trades being executed in microseconds, and the notion of out trades has kind of gone by the wayside, and yet for some reason, we still have this scenario where open interest only updates once a day. So walk us, our friend Axel D, through why? Why is that the case?
Okay, I love this question because there's something in here for everybody. Simply put, open interest for the newer people on Bootcamp, it's the number of options contracts that exist for a particular stock. So as opposed to stocks themselves, which have a fixed number of shares that are outstanding, there's no minimum or maximum number of option contracts that exist for any given underlying. So there will simply be as many contracts as trader demand dictates. So whenever you trade an option contract, you might be creating a brand new position, what we call opening, or liquidating the existing one, which is closing. Now, every day with the Options Clearing Corp, OCC, what they do is they look at the volume of the options traded, and they basically make a note of how many were marked to open versus to close. And once they've tallied up those numbers, they can determine what we call open interest, or OI. Now, OI is officially posted by OCC the morning after any given trading session. So for whatever we do today, with today Wednesday, we'll see that tomorrow, Thursday. Once all these figures have been calculated, so for the remainder of the day, those figures remain static until the next trading day when the new figures are made available. Now, the main benefit of trading options with high open interest, if people care about OI, it tends to reflect greater liquidity for that contract, which is typically better for pricing and getting in and out of positions and so forth. And that's why OI is such an important piece of data for options traders.
Mr. Rock Lobster, anything you want to add there about OI, the importance thereof, or anything else you want to add for, what was it?
For Axel, I think part of the reason, too, I don't know if Jill mentioned it, but there is options take their one-day settlement. So they got to settle before they can have open interest. So you have the transaction, but then they got to settle. So, the money changes hand and they exist. So that's one reason. As far as open interest goes, it is sometimes it's interesting. Sometimes it's not interesting. Sometimes it is easier to close a contract. So when there's a lot of open interest, because liquidity provider might be more apt to trade something closer to fair value just to get out and unwind a position, let's say if they have too many. So yeah, there's definitely something to that. It also could see where there's, somebody has a massive position, and then you could see, but it's kind of, to me, it's like, it's very hard, like we do it in an odd block, just trying to parse the open interest. You never know if they trade stock against it or what the deal is. So it's not always what it appears.
You heard it from the Rock Lobster. Open interest, not interesting. I like that. But yeah, it has a lot of impacts. Obviously, as Jill mentioned, liquidity, usually it correlates. High open interest, usually, not always. Could be just one big trade that's sitting there, but usually it correlates to a little bit more volume, hopefully a little bit tighter spreads, a little bit easier to trade in and out. Speaking of out, we have to get out of here. That's all the time we have here for this episode of Options Bootcamp. The hour just flies by when we're answering your questions. Keep those questions coming. We pretty much got through about 1.5 episodes, or not even, worth of questions. We still have quite a backlog. But that said, keep those questions coming. We read them all, even if we don't have a chance to answer all of them on the air. If we don't, we'll write to you. Or maybe what we have been doing lately is also filtering them into like Option Block and some of our other more frequent shows, just so you guys don't have to wait as long for some of your questions. So keep those questions coming. You guys know how to hit us up, clearly, and send us those great questions. All those great curveballs you love sending us, like writing strangles on CFDs. What fun it is with questions like that. All right, before we go, one last time around the horn, let's start over there in NASDAQ land. Jill, while she's still stateside before she's on her next globe-trotting adventure. Jill, what is cooking in the land of NASDAQ? And if our listeners are intrigued, they want to learn more about NASDAQ and particularly NASDAQ's options initiatives, where should they go? What should they do?
Right. We can be found all over social media on Twitter, Facebook, LinkedIn. I think we have we have Instagram also at NASDAQ. It's easy to remember. And, of course, you can find what I have working on exclusively for my show, Trade Talks, which is everything all about trading, at Jill Melandrino. And we will be at the Futures Conference, the FIA Expo, in October. So we'll be reporting on a ton of great stuff from there as well for the October shows that we're putting on for Options Insider.
Yeah, we'll have to bring you into the studio, I think, during FIA in a couple of weeks. We can actually do this show in person. How does that sound?
I love that. I love everything about that.
And we'll just leave Andrew out of it because we don't need him. It'll just be you and me having a fun show. I like that. That's a good idea here in the old Options Insider studio. So stay tuned for that, listeners. But before we go, he joined us. We might as well give him a chance to plug. Mr. Rock Lobster, when is your next row webinar, sir?
The next row webinar.
Never.
The funny thing is, I just was talking to Mark about my Easy VIX webinar. He's like, it's still too hard, so I have to rewrite it because it's too hard. That will be in early October. Look for the free webinar pretty soon. I think we'll be doing it maybe the 10th or the 12th. That's sort of the plan. And then if you like that and you want to learn more, if your eyes have been opened, you can give us some money and we'll teach you some more stuff.
Hit them up over there at optionpit.com. You too can learn about Easy VIX. Maybe you'll become a market maker someday as well. You follow that trajectory to its ultimate and logical conclusion. And on behalf of the Rock Lobster and Jill, who want to give her a nickname one of these days, we're still figuring that out for her, and indeed myself, I want to thank all of you out there in the listening audience for downloading, streaming, and subscribing, and of course, for sending in such great and varied questions. Keep those coming. We love them all. And we'll see you next time for more Options Bootcamp.
Options Bootcamp is brought to you by NASDAQ. From its inception, NASDAQ has been an innovator and agent of change in the financial markets. It's in our DNA. From the development of electronic trading to our drive to bring enhanced functionality and world-leading technology to our suite of 6 options exchanges, we exemplify customer focus, consistent technology, and streamlined solutions. NASDAQ, tech forward, leading the U.S. options market and continually rewriting tomorrow.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.